Good morning, everybody. I'm David Peteler with Horizon Legal. Excuse me. And this is not COVID, this is seasonal allergies. I'm here today to talk about your Series A financing. We call it the legal stuff. Now, I know a lot of the Minibar presenters like to pride themselves on being kind of geeky and nerdy, but some of this legal stuff is really super geeky and nerdy. There's a lot of material here. We're going to go through it pretty quickly. Save your question. You can ask questions at any time. The chat room is available, and I'll try to make time at the end for questions. So we'll move forward here. To start out with, I should give you the little disclaimer that Horizon Legal is providing this information as part of our ongoing commitment to the public good. Materials provided are a summary of the resources available. They do not constitute legal advice. This means you have not hired me. I'm not giving you formal legal advice. You can't sue me. So there. Okay. So now, what is a Series A preferred stock? What is Series A preferred stock? I'm going to start with kind of a global conceptual discussion, and then we'll move into more granular level. Series A preferred stock is a series of stock that's a separate series, separate from common and others. It's Series A because it's the first in the series. There can be a Series B and a Series C. And it has basically a couple of different things. It has a set of preferred rights on major events. This is liquidation, dividends and distributions, merger and conversion into common. It used to be that when I was doing a lot of this work in Silicon Valley in the 80s, the idea was to take the company public. That was the exit mechanism. So we all worried about conversion into common stock at the time of the IPO. Now conversion frequently happens prior to a different kind of exit event, but it's the same general concept. Now, another piece in this is that the fact that the Series A has preferential rights allow for a price differential. So what you do is you set up two tiers, the preferred and the common. You sell the preferred to outside investors at a higher price to raise your capital. And you keep the common stock at a lower price by virtue of the fact that the common has less rights and privileges. So that allows you to, in rough terms, let's say you can sell preferred stock to investors at $1, but you can at the same time you can grant options to your key people at a dime, and your key people would much rather have options at a dime than at $1. So that's a good reason to have it. Okay, there are 4 major areas that we want to concern ourselves with: the economics, the power and control, the ancillary rights, and the alignment of investors and company. I didn't need to tell you that a lot of this has to do with economics, power, and control, right? That's what this is about. There are some ancillary rights that sort of implement all of those things. And a key piece in all of this is you want to make sure that your investors are aligned with you as best possible. That's why you want them. So let's go up here. Where do we go? There we go, economics. So we start out with a valuation of the company. The investors are going to look at at the post-money valuation, and they're going to use that to work back to a price per share in the offering. I'm not going to talk about valuation. That's a whole other subject. But as you can imagine, the valuation is important. I'm going to mention right here that if you have safes or convertible notes that have valuation caps on them, this is where they will come to haunt you. We'll talk about that a little bit. Now, we talked about the preferential rights package, and there are a couple of different approaches to that. We talk about, I mentioned that liquidation value is one of the rights in the preferential package. It's not that people expect the company to liquidate. That's not it. But liquidation preference kind of sets up some different things. So a basic concept would be on a liquidation event, the Series A would receive 100% of its investment first, and then the common would receive the rest. So let's say the Series A stock puts in $1 million. You liquidate the company, we can talk about that later, but you liquidate the company for $2 million. That means the Series A gets their $1 million back and the common takes the other $1 million. There's another approach which basically says the Series A receives 100% of their investment plus X. And that could be 10% per year. Sometimes it's 150% of their investment. This is a matter of negotiation. So if we had let's say we had an interest component, let's say we had an interest component concept in there. So the $1 million at the time of the liquidation event had accrued, essentially, quote unquote, accrued interest to $1.5 million. So at a $2 million liquidation, the Series A takes $1.5 million, and the common only gets $500,000. There's another approach, this is called the participating preferred approach, which is the Series A receives 100% of its investment first, and then the Series A and the common share the rest. So let's go back to our first example of the $1 million investment and the $2 million liquidation. On those facts, the Series A would take its $1 million, and then the Series A and the common would share the remaining $1 million, and they would share. Typically, you share on a pro rata basis based on the number of shares, assuming conversion to common. So if the common stock owns, if the common shares account for 2/3 of the company and the Series A account for 1/3, then that $1 million would be split, 333,000 to the A and 666 to the common. So you can see under these different scenarios, the common stands to get very different results. Now, I talked about conversion. An important thing is that on certain events, you need to essentially force a conversion of the stock. One of them is an IPO. Underwriters don't want to take a company public if it has preferred stock out there. Another is on a merger or an acquisition. If you are the target in a merger and you are merging into another company that does not have a class of preferred stock, they don't want to set up a class to accommodate your preferred holders. So they want your preferred holders to convert down to common, and then they'll convert everyone over on that basis. So how do you convert? Typically, you start out on a 1-to-1 basis. So if 1 share of Series A stock would convert to 1 share of common. Now, sometimes it's done on an economic basis. So if the Series A is worth $1 and the common is worth $0.10, then the Series A converts into 10 shares of common. That's not a result the company tends to want. So we'll start out with a 1-to-1 preferred to common conversion ratio. Now, that can be adjusted for economic events such as stock splits. So, for example, if you split the common, then the preferred would convert into, let me back up. If you split the common but do not split the preferred, do a 2-for-1 split or 1-for-2 split of your common, then your preferred would convert into 2 shares of common instead of 1. So basically, it gets the same economic value post-split. Sometimes you see a deemed interest rate. So again, the longer the preferred is in there, the more valuable, quote unquote, it becomes, and you adjust the conversion rate appropriately. There's another concept called anti-dilution. This concept basically says that if after the Series A round is done, new shares of any kind of stock are issued at less than the Series A purchase price, then the Series A conversion rate changes. Now, there are several different formulas for doing this. I don't want to get too detailed about this. On one end, we have what's called the ratchet, and that's the investor-friendly, company-unfriendly version. So the ratchet says that if you issue even 1 share of stock at less than the price of the Series A purchase, then all of the Series A converts at that issue price. So let's say that you have your Series A at $1 a share. Under normal circumstances, they would convert 1-to-1. Now, let's say that you've issued one share of stock at 50 cents a share. Under this scenario, all of the preferred would convert, all the Series A preferred would convert at the 50-cent mark. So you'll get double the conversion, and that will have a negative influence on or negative impact on the common value. That's the one end of the ratchet. The other end is what's called a wide base, a broad base anti-dilution, which is basically you say, we're going to take the weighted average of all the shares outstanding on a fully diluted basis. So this means we assume the conversion of the preferred, we assume the aversion of any convertible notes, we assume the issuance of all the options that might be authorized, whether they're issued or not, the ones that are authorized. So you get the fully diluted number, and then you take the weighted average. So how much harm to the Series A was done by issuing these shares at a lower price, and you work out a small, so it'd be a smaller change in the conversion rate. In all of these situations, the conversion rate does not change upon issuances of options under the agreed stock option plan. So one of your negotiating points here is that you're going to say let's say we have an option plan of 500,000 shares. So we can issue up to 500,000 shares at whatever the price is for the options, and that will not change the Series A conversion rate. And that's typically a point of negotiation. How big is that stock option plan? How big can it be? Sorry here. All right, now we're down at power and control. This is where it gets more fun. I don't know, maybe you enjoyed having the discussion on common stock. That's kind of fun too. Excuse me. First of all, your Series A investors are going to want a director position. They may want more than one. They will then want a voting agreement to keep that Series A director or directors in place. The voting agreement, the voting agreement is basically an agreement between the Series A holders and the common holders, or at least the major common holders, that everyone will vote their stock to keep that Series A director in place. The Series A director or directors will also want director indemnification agreements, because if anything goes wrong, they want the company to indemnify them. Let's see, sometimes the Series A, if there's one investor or if there are multiple Series A investors, things can be a little bit different. But sometimes the Series A group as a whole will want the right to appoint a director, with the idea that the director could change from time to time. From the Series A point of view, that's great, because the person they appoint as the director today might be assigned to go someplace else, next year, and so they want to put someone else in that person's position. From the company's point of view, you want to be sure that you have some say in this matter, because frequently you'll have a good rapport with the person who's appointed to be the initial director, but when that person leaves or moves, they put someone else in that you may not have such a good rapport with, who's just not as well aligned, and you'd want to have the say to say, look, this person's fine, but we'd really have someone else in this spot. Please change your choice. And then Series A preferential voting power, that basically says that the company can't take certain actions without the approval of the Series A, so it's a veto. Some of those actions, not all, but some of the big ones are the company can't amend its articles of incorporation. It can't change the size of the board or appoint directors. It can't issue new stock, or it can't merge or sell the business or sell an important asset, for example, without the approval of the Series A. Ancillary rights. The investors will want kind of a basket of rights that sort of help implement all the things we just talked about. One is they'll want information rights. They'll want rights to financial statements, monthly, quarterly, annual. They will probably want access to budgets. They'll want some other information rights. They'll want rights of first offer. Right of first offer says that if the company is going to issue new stock, then the Series A get the first right to buy that stock. Now that could be good for the company, that could be bad for the company, but that's how that works. They'll also want rights of first refusal, which says if anybody wants to sell, any one of the existing shareholders wants to sell their stock, then the Series A holders have the first right to buy that. Or if not the Series A, then at least the existing shareholders. The reason is you want to sort of keep the stock in the family. There's a right that I like to have in these documents called the drag-along right, and that is to say that if the company receives a proposal for a purchase, whether it's a merger or a assets acquisition or whatever, if there's a proposal for a purchase of the company, if that proposal is approved by the board and by a majority of the shareholders, then the other shareholders have no right to dissent or complain, basically, and they have to go along. They get dragged along with a transaction. This is useful because sometimes you'll have one or two small holdouts who want to be essentially the squeaky wheel, hoping they can get the extra grease by trying to hold up the sale of the company. The next right is called a tag-along right. Sometimes it's called a co-sale right. And that basically says if one of the shareholders finds someone who wants to buy some of their shares, then everybody gets to sell a percentage of their shares in that sale. So let's say someone finds someone who wants to buy 1,000 of their shares. Then everybody has the right to put some of their shares pro rata into that 1,000 share lot that's being sold. Again, that can be great for people wanting to get out. That can be a real problem for the poor guy who found the buyer and now can't sell. He can only sell a small amount of the shares he thought he was going to be able to sell. Retention of key people is the next concept here. When you the investors are investing in the company in large part because of the people, and they want to make sure that those people stay around at least through the time that has been contemplated by the business plan that the investors are investing into. So this will be, typically it'll be the founders plus key people, key technical people, maybe a key finance person, whoever, or a key marketing person, whoever it is. And so they'll require that all these people submit their stock to vesting schedules. Vesting schedules, excuse me, you probably already know this, but a typical vesting schedule in a Series A deal is 4 years. With a 1 year quote unquote cliff vesting, so you vest in no shares for the first year, and then on day 365, excuse me. Well, actually, on day 366, you vest in 25%, and then for the following 3 years, you invest usually monthly afterwards. All of this takes a lot of documentation. So let's go through the kind of the basic documentation. And this is just a kind of a characteristic list. There may be more, there may be less, but there will probably be more depending on the specifications of your deal. You'll start out with a term sheet. Typically, the investors will provide a term sheet to you. I have a copy of the National Venture Capital Association Series A term sheet. We don't really have time to go through it. It's a fairly lengthy thing, and it shows all the different provisions that you normally see in a term sheet. It provides 2 or 3 different variations for each term. It provides footnotes as to whether this works in Delaware, whether this works in California, whether you want to try this in other states. It's a very complicated. I shouldn't say complicated. It's a pretty exhaustive document. I will be happy to send you a copy of that. You can certainly get it online at the National Venture Capital Association website. If you want to send me an email after the presentation is done, I'll send you a copy of the PowerPoint if you'd like it, and a copy of the term sheet so you can take a look at it. So this term sheet will kind of start out your terms. That's your negotiation. That's the start of your negotiation. You'll try to get to a final term sheet. Then you will need to amend your articles of incorporation. The Series A preferred stock, any kind of preferred stock, is a creature of the articles of incorporation. It is formed and exists, and its rights are specified in the articles of incorporation, certificate of incorporation if you're in Delaware or other states. So that will be heavily revised. It'll move from being a 2-page document to a 20-page document. There will also be amendments to your bylaws, which will probably have to do with directors, indemnification, and that sort of thing. You'll have a Series A stock purchase agreement, which will run 40 to 50 pages. That will have a lot of your covenants, terms, and conditions. You'll have an investor rights agreement, which brings in some of those rights that I discussed, such as the rights to financial information rights of various kinds. Probably the director's indemnification rights will be in that agreement. Depending on the IP that you have, there will probably be IP assignment agreements to make sure that the founders, or whoever owns the IP that the company is using, has either assigned the IP into the company or has properly licensed the IP into the company. There will be a management rights agreement, which has to do with some of the voting rights and whatnot that the management has. There'll be a right of first refusal and co-sale agreement. There will be a voting agreement, as I mentioned. This is the one that votes, where everyone agrees to vote their shares to keep the Series A directors in place. There will be service agreements and vesting schedules for the key employees, and there will be board and shareholder consents to sort of tie all this together. Because it's a securities offering, you've got to comply with securities law. Usually that's Reg D and then associated state filings. I'm going to move quickly because we don't have much time. When you get prepared, first of all, you're going to have your business case. I'm not going to speak about that. You know that better than I do. You want to get all your due diligence put together. You want to make sure all of your corporate documentation is in place. You want to make sure that your founder shares are actually issued. You want to make sure that there are service agreements in place, confidentiality agreements, IP assignment agreements, stock restriction agreements, and that sort of thing. Real quickly, I've seen situations where the company did not get around to issuing shares to the founders. Then there's a financing event. So there's a financing event where the VCs are going to buy 1/3 of the company for $1 million. So the company is now worth $3 million nominally. So the founders own the other 2/3. When now they issue themselves shares, and those shares are worth, you guessed it, $2 million. They have a $2 million tax hit. So you don't want that to happen. You get the shares issued way in advance. Now, the next piece, and this is really critical, is your cap table analysis. What the VCs want to see is a pro forma, fully diluted, post-money cap table. I'm going to race through this because we only have a couple minutes left. If you look at this, you start out with your founders, and you see your founders had 1.5 million shares between them. They each had 1/3. Put in an option plan of 350,000 shares, which is about 19%, which is respectable. Then you had some convertible notes, and when you got around to converting them, they converted into, one of them was 137,000 shares, another at 68,000 shares. You had a safe, and the safe, I've got some basic numbers down here, but your safe had a valuation cap. So all of a sudden that safe converts into 250,000 shares of the stock. And then the investors, were valuing this company at $3.3 million post-money, which is nice. And they're buying they're investing $1 million at a $1 share price. So they put in $1 million, and they end up with 30%. Now, after you've taken into account the founder stock, the option reserve, the conversion of the convertible notes, the safe with a valuation cap in the Series A, the founders are down at less than 50% as a group. And I have seen this on more than one occasion where there were safes issued with a valuation cap that ended up being way too low, a lot of convertible notes with big interest rates and that sort of thing. And when you finally get around to converting everything down in time for your Series A preferred stock, your founders are way down below 50%. So just there may be nothing you can do about it, but just keep an eye on that. So I have about a minute left. I know this has been very fast. I'm happy to entertain any questions. All right, then. I'll take that as a yes. Even with COVID's, deals are getting done, so it can be done. Go for Angels is active. Angel pollination. Investors are warming up to Zoom. So here's my information. Give me a call or send me an email. Let me know. I'll be happy to send you these the PowerPoint presentation and the National Venture Capital Association term sheet. No questions at the moment. All right. Well, thanks everybody. I guess I'm done. I hope you enjoy the presentation, and I hope you enjoy the rest of the minibar session. Bye for now.